Welcome to our USD/JPY analysis report, covering September 29th to October 4th, 2025. In this presentation, we'll examine the recent price action, key market drivers, and provide trading recommendations for both short and medium-term horizons. Our analysis is based on comprehensive data from multiple trusted sources including TradingView, InvestingLive, ActionForex, Forex.com, and DailyForex. Let's dive into the details of this critical currency pair. The USD JPY pair experienced significant volatility this week, trading at 147.46 with a modest daily gain of 0.14%, but showing a weekly decline of 1.56%. The pair fell for 4 consecutive days before finding support around the 146.00 to 146.30 zone. This downward pressure was primarily driven by the US government shutdown that began October 1st, shifting Federal Reserve rate cut expectations and ongoing discussions about potential Bank of Japan policy tightening. Despite the recent decline, the substantial interest rate differential between the US and Japan continues to provide underlying support. Several key news events shaped USD/JPY movements this week. First, the US government entered a shutdown on October 1st after Congress failed to pass a funding bill, delaying critical economic data releases and weighing on the dollar. Second, markets are now pricing in 2 Fed rate cuts by year-end, with weak labor market data increasing dovish bets. Third, the Bank of Japan is showing signs of hawkishness, with 2 board members voting for a rate hike and discussions about a potential 0.25% increase in October. Finally, declining oil prices benefited energy importers like Japan, providing additional support for the yen. From a technical perspective, USD/JPY is at a critical juncture. The pair is testing major trendline support around 146.00 to 146.30, which has held during recent tests. Key resistance levels include 148.12 to 148.21, 149.12 to 149.40, and the psychological 150.00 level. On the downside, a break below 145.47 would signal a more significant bearish shift. The 50-day and 200-day EMAs are currently converging, indicating market indecision. Momentum indicators show oversold conditions on the 4-hour chart, suggesting a potential bounce, while the expanded average daily range indicates strong selling pressure that may be nearing exhaustion. For the short term, we see 2 potential scenarios. The bullish scenario, with 60% probability, involves support at 146.00 to 146.30 holding, leading to a rebound toward 147.50, 148.50, and potentially 149.40. This could be triggered by resolution of the US government shutdown or stronger than expected economic data. Our recommended strategy is buying between 146.00 to 146.30, with stops below 145.40. The bearish scenario, with 40% probability, involves a break below 145.47 support, targeting 144.65 and possibly 142.66. For this scenario, consider selling rallies to 148.00 to 148.50, with stops above 149.50. The medium-term outlook presents a more balanced picture, with USD/JPY likely remaining within the broader 140.25 to 151.00 range that has characterized most of 2025. Key factors to watch include Federal Reserve policy, Bank of Japan decisions, the interest rate differential, and political developments in both countries. From a technical perspective, the outlook hinges on whether the pair can break decisively above 151.22 or below 145.47. The most likely scenario is continued range-bound trading between 145.00 and 151.00, favoring buying near support and selling near resistance rather than trend-following approaches. Several risk factors could impact USD/JPY trading in the coming weeks. US economic data, particularly labor market figures once the government shutdown ends, could significantly influence the pair's direction. Bank of Japan policy signals regarding a potential October rate hike should be closely monitored. The duration and resolution of the US government shutdown will affect dollar sentiment, while Japan's LDP leadership election outcome could influence BOJ policy expectations. Traders should remain vigilant for unexpected developments in these areas, as they could introduce additional volatility to an already uncertain market environment. Successful trading requires strict discipline, especially in volatile markets. Limit position sizes to 2 to 3% of trading capital to protect your portfolio from significant drawdowns. Always use stop losses and avoid moving them further from entry. Be mindful of correlated positions in other yen pairs that could amplify risk. Consider reducing exposure during major economic releases and before weekends, given the current political uncertainties. Wait for technical confirmation before entering positions, and remember the wisdom of legendary trader Ed Seikota. The elements of good trading are cutting losses, and cutting losses. Following these principles will help preserve capital and improve long-term results,